So how the TTM squeeze is constructed is when the Bollinger Bands contract to be inside the Keltner channels. The settings are usually the 2, the 1.5, and the 1 ATR. So whenever the Bollinger Bands constrict to fall within those parameters, so the black dot would be like within 2 ATR, the red dot would be within 1.5 ATR, and the orange dot would be inside 1 ATR. And so when you get the squeeze, you'll start with the black. The black is the only one that you can have on its own. If you have a red, it means that you have a red dot squeeze with a black dot squeeze underneath it. And if you have an orange, I don't remember the last time we've had an orange on the SPY, but an orange would basically, this would turn to orange. So maybe on the 5 minute or the 1 minute, maybe 1 minute we can probably find one. Yeah, okay, here. Right, so when it's green, it means there's no squeeze, right? So green is the default setting. Then we get the black dot squeeze. In this case, it actually went right to red. But so here, green, then we have the black dot, that's the low compression. Then we have the red dot, which is the normal squeeze. Then we have the orange dot. When the orange dot fires, right, so when the orange dot fires, that means that there's still a red dot. When the red dot fires, that means then there's the black dot. And then finally, the squeeze has exhausted its energy. So think of it as if it's a coiled spring. And then when it breaks out, that energy needs to be released. And so once they change color, that's when the squeeze is considered to have fired. So when this changes from orange to red, it means the orange dot has fired, now the red dot. And so it still remained within that red dot squeeze parameter. So the Bollinger Bands were still within 1.5 Keltner channels. And then boom, that popped out. And then when we finally popped out of here, you can see we broke above that 2, and then that squeeze fired. So for an entry, I like to enter when there's already a squeeze in place. And so when I am looking at the squeeze, it's very important to look at what's happening with price action. Okay, so just because there's a squeeze doesn't mean you should go long or go short. It just means that you can pay attention to what's happening. I know some people, especially John Carter himself, when he said it, he doesn't look to enter until there's at least, I think he said 4 or 5 dots, or maybe 3 to 5 dots, and usually after the 6th dot is where it's likely to fire. And so how we use it is when we have EMAs that are stacked positive, right? So here you can see we were in this squeeze. We were stacked positive. We got a STRAT set up here, right? So we had a 2-2 to the upside. Based on the EMAs, we would have been stacked positive. You'd have to check to make sure that your time frame continuity is also positive, right? Remember, we used the STRAT first, and then you would have had your entry around here. So then when this fired off, it fired long, and wow, that was a crazy move there. That was yesterday, no, 2 days ago. And then to the downside, so anytime you have a clean setup is when I would have the shaded background. Basically, that means you have your stacked positive EMAs. The 8 is above the 21, above the 34, above the 55, above the 89, above the 200. When you don't have a clean setup, usually it indicates that more than likely it's going to fire to the downside. But again, you have to pay attention to what's going on with price action, right? So here you can see we had this gap down. Here the EMAs were stacked negative, right? So what happened, we had the squeeze, it fired, but it didn't really do much, right? So this one, well, actually no, this didn't even fire. So this actually turned to a red dot squeeze. And then when it did fire, right, we consolidated here, we moved a little bit higher, we came back into the squeeze. Again, this would have been one of those where you just kind of got chopped around, right? And sometimes it happens. If you took every squeeze trade, over time, yes, you will win. The odds are in your favor, but you can see here when we started to shift, again, we started to move, got a lot of consolidation, started getting some buying here, came above the 200. When that squeeze fired, it fired long. Again, did we have a setup here already? Yes, we had this hammer. We had the 2-2 rev strat. And then again, we were stacked positive. When the squeeze fired, we had already gone negative, so the EMAs were no longer stacked. You can see from the background. So when that fired, again, we already had that 3-2 to the downside, and then we had the 2-2 continuation, right? So we had this, it was a hammer, but it was red. And when that fired, it took us to the downside. So the most important takeaway from this is when you're using the TTM squeeze, look at what's happening with either the moving averages, but first and foremost the strat. So make sure that you have a strat setup, okay? Because we are first and foremost stratters. We use the TTM squeeze to give us an idea of when volatility is contracted. As options traders, especially, buying when there's low volatility means that our options premiums, especially as buyers, would be cheaper, right? So it's more beneficial for us to buy when there's low volatility. And then, of course, when we sell, right, you sell into that gamma spike, you sell into that IV spike, and that's when you come out with, some pretty good trades. So hopefully that explains how the TTM squeeze, the dots work.